Happy spring, everyone, and thank you for watching this video. My name is Roger Conrad, and I'm the editor and publisher of Conrad's Utility Investor. I'm going to talk about three things. First, how utilities and essential services stocks are holding up against what I call COVID-19 fallout. Second, an update of the Conrad's Utility Investor investment strategy, how we're taking advantage of opportunities and avoiding risks that are slowly but surely creeping up on many investors. Lastly, I'll answer three recently asked questions from our investment community. This has been an exceptionally volatile year for the stock market, and the record number of dividend cuts has made it particularly rough for income investors. Even utilities and essential services haven't been immune. In fact, I call out 5 recent dividend cutters in the May issue of CUI. But utilities on the whole have been resilient. Their core strength, what they provide is, well, essential, or more accurately, critical to a functioning modern world. So demand for what they sell rarely goes up or down much. And that makes them steady go-to stocks, especially in an economy that's contracting as fast as this one is. I can also say my 5-part quality grade system to identify best-in-class companies is working. Even with so much truly unprecedented, companies in our 3 model portfolios have stuck to 2020 guidance they set prior to COVID-19 fallout. Think about that for a minute. This is a time when 70% of S&P 500 companies have either cut guidance or pulled it completely, which is basically management admitting it doesn't know what to expect. You can't really blame them. These are extraordinary times. But if executives can't project how businesses will do, how in the world do investors and analysts expect to? And that, my friends, in my humble opinion, is the biggest danger facing investors now. Stock prices are rising as though everything is fine, but companies are saying loud and clear they don't know what damage COVID-19 fallout will do. It doesn't take a lot of imagination to see what could go wrong here, but we won't have to worry about it happening to best-in-class utilities and essential services companies. Their Q1 results, their guidance, and the very nature of their businesses say we can trust them to perform. And that's not something anyone can say with any confidence about any other industry right now. The April issue of Conrad's Utility Investor focuses on risks posed by COVID-19 fallout for the nearly 200 companies in my coverage universe, as highlighted by my quality grade system. May examines growth opportunities, Q1 results, and guidance. They're essential readings for members of our investment community, and I'll be following up on the key themes the rest of this year. As for that risk that's slowly but surely creeping up on investors, this is very likely our last best chance to avoid it. That's why point 1 for my investment strategy is to sell all stocks, bonds, and preferred stocks of companies where underlying businesses are weakening. That goes for affected ETFs as well, which always hold a sector's bad and ugly as well as the good. Point 2, raise some cash. The profit-taking opportunity I highlighted in mid-February is over, but there are still plenty of sell-rated companies in the utility report card. And finally, build a shopping list for the stock market's next leg lower, or if prices are driven down by sector switching and other technical reasons. In late March, almost every portfolio stock sold for less than its dream buy price. Dream prices will only be reached under extreme conditions, but if purchased there, will generate windfall gains. Only a few portfolio stocks now trade at dream buy prices, but almost all sell below my highest recommended entry points. I set these prices to generate annual returns of at least 10% a year, which is still a pretty effective way to build wealth. So there's a brief look at my market outlook and strategy. Here are answers to some recently asked questions. Starting with Lou E., who writes, "Do you still recommend Vanguard Intermediate Tax Exempt Fund? It's been strangely volatile lately." I do, but with the caveat that weakening state and local government budgets and overheated election year rhetoric could still trigger volatility. This fund has nearly 10,000 individual bonds, the vast majority rated at least A and maturing in 5 to 7 years. That protects against both credit risk and interest rate volatility. It has very low expenses, a high tax-advantaged yield, and a history of steadiness. Politicians are politicians, and the risk is more noise could cause a temporary decline of 5% or so in the fund's net asset value. If that's a real concern, I recommend the Vanguard Federal Money Market as an alternative. The second question comes from our most recent subscriber web chat. Lawman asks, why has AES Corporation taken such a beating lately? I think it's a question really of mistaken identity. Sellers are treating AES as if it were still the company that nearly went bankrupt in 2002 and stumbled again in 2008. But it's anything but. In fact, this stock's slide this year is sharply at odds with company performance. Key points from Q1 results are AES is still on track to meet free cash flow guidance and debt-cutting plans this year. Its contract generation and regulated utility model is holding up well. Foreign currency exposure is not triggering meaningful losses, and renewable energy construction is on track. This stock trades at less than 9 times expected 2020 earnings based on conservative guidance. The yield is close to 5% and growing at a mid-single-digit rate. That's very attractive, and I rate AES a buy up to 22. And third, a question from Gary regarding our CUI Plus service. I've been a longtime subscriber, starting with Utility Forecaster and continuing with CUI. Just subscribe to CUI Plus. What is your recommendation for incorporating CUI Plus companies? First of all, Gary, thank you for giving CUI Plus a chance. We treat CUI Plus as a unitary portfolio, which means we advise on how much to buy as well as where to get in. On a practical basis, though, I realize readers will integrate what's there with the rest of their stocks. The CUI Plus portfolio is drawn from outside CUI's essential service company universe. So what you buy should enhance diversification and balance. The main thing is not to let a single position grow large enough to sink you if something goes wrong. If you follow that rule, whatever you include will boost growth and safety. Well, that's all I have for now. Thanks again for watching. I'll look forward to our next message.